All right, so today we're talking inflation again, but this time we're digging into more scary headlines, talking about the 90s, and giving you some advice on how to think about all this. We're seeing the biggest surge in inflation in the last 30 years. The Consumer Price Index rose 6.2% in October from the prior year, according to the Labor Department data released earlier this month in November. The CPI also rose 0.9% from September to October, and this is the largest month-to-month increase in 4 months. Core inflation increased 4.6%, the fastest gain since August of 1991. Bloomberg stated that this exceeded all estimates. Basically, the experts did not predict this one. It's way worse than they thought. This is the most significant increase in almost a whole generation. That 6.2% increase was the biggest since 1990, when oil prices soared in the months before the start of the Gulf War. Now, I remember the 1990s, but I bet a lot of you watching, especially in your 20s, don't really remember that time. And that makes me feel pretty dang old. Now, the United States tries to aim for as close to about 2% annual inflation for what's considered a healthy economy. It may not always be 2%. Like, for example, in 2018, it was 2.4%. And then in 2019, it was 1.8%. While in 2020, that was an aberration, an obvious outlier at 1.2%. President Biden was recently quoted saying that the inflation hurts American pocketbooks, and reversing this trend is a top priority for him. Biden also noted that the largest share of increase in prices in this report was due to rising energy costs, and he asked his administration to take action to combat any potential price gouging going on. Now, the CPI report also showed price increases across the board for nearly every sector of the economy. So we're talking energy, housing, food, used cars and trucks, medical care, new vehicles, household furnishings, and recreation. One thing to note here is that the only categories that did not see any increase in prices were actually airline fares and alcohol. That one surprised me a bit. But yes, now is the time to stock up on that alcohol and buy that one-way flight and never look back, right? I know you're thinking it. Okay, so as bad as all this sounds, experts also predict that it's probably going to get worse as 2021 comes to a close. Many investors are betting that there will be at least 2 25 basis point hikes in the next year, which raises yields on 5-year Treasury securities. This is basically what everyone's referring to when they're saying rates are going up. Okay, so what should the government do? The president has consistently stated that monetary policymakers are responsible for addressing inflation. So this is the Federal Reserve that we're talking about here. You know, that agency that you constantly hear about, but do you actually know what they do? Well, according to their official website, the Federal Reserve System is the central bank of the United States that performs 5 general functions to promote the effective operation of the U.S. economy, and more generally, the public interest. What are those 5 functions? Well, I went to the Federal Reserve website again. I had to read it over and over again. I could barely even understand what they were even talking about. Lots of jargon in there. So let's just summarize it. Basically, they conduct national monetary policy, supervise and regulate banks, maintain financial stability, and provide banking services. Everything having to do with money, the feds handle. So really the key here when talking about inflation is their function of conducting monetary policy, and their end goal is maximizing employment, keeping prices stable, and then moderating long-term interest rates. This is where they really are in charge of kind of handling or controlling inflation like we always hear. How do they actually conduct this monetary policy and then moderate inflation from there? So in times of inflation, they attempt to tighten the policy by raising short-term interest rates that banks lend to each other. When they do that, it makes borrowing less attractive through higher rates. And this really does affect all types of borrowing, like personal loans, mortgages, interest rates, credit cards, kind of all that stuff. It also makes leaving your money in the bank a little more attractive because it's accruing more interest as well. And if you can make more money on your cash, you might be tempted to leave a little bit more of it in your savings account. However, this is not something I'd consider now. Even if I can make a bit more money on my cash savings by leaving it in the bank, I still don't want to lose buying power through inflation by letting that cash sit there. Every day you're letting your cash sit in the bank, you're basically losing buying power because of high inflation. So the reason they want to make borrowing less attractive is they want to slow down the amount of capital going into the open market. It's a way to slow down an economy that's just heating up too much. Now, we all know the government printed a lot of money since March of 2020 to keep the economy from crashing. So now they combat this by selling Treasury securities on the open market and absorbing that capital. And in doing so, they hope to absorb extra cash that they'll pay back at a later date. Now, people won't buy Treasury securities unless the rates are attractive. So the feds have to sell these securities at a higher rate. Okay, So what can we do if we should expect higher rates? If you haven't refinanced your mortgage from those pre-pandemic rates, now is the time to look in that lower rate and lock that in. For homeowners, your home was likely your largest one-time expense and likely your largest monthly expense as well, and your mortgage and property taxes and things like that. Recently, CNBC reported that the average interest rate for 30-year fixed-rate mortgages decreased to 3.16%. So rates may stay low for a little bit longer, but that might not last. Refinance demand also rose recently, so it's clear everyone is thinking about the same thing of getting that rate locked in before rates potentially go up. Now, sometimes refinancing sounds like this mythical idea everyone always talks about. So let's just put it in a clear perspective. If you have a $500,000 mortgage, let's say, 30-year standard fixed rate, and you're currently paying 4.5% interest rate, and you originated that in 2020, you're paying about $2,533 per month on your mortgage. If you were to refinance this to, let's say, a mortgage at a 3% rate, your monthly mortgage payment would drop to a little over $2,070. That's about a $460 monthly decrease. And you could potentially save $120,000 in interest over the lifetime of your mortgage. Now, $120,000 is a lot of money. So no matter what time frame we're talking about, it's worth looking into this. And if rates are expected to go up, you'll also want to consider locking in that rate with a fixed rate mortgage as opposed to a variable rate mortgage. If your home value has increased, as most have, right, and especially if you bought in 2020, it's probably gone up since then, you may now have a little bit more equity in your home that you want to take advantage of through what's called a cash out refinance. I would just caution this strategy a little bit because you got to be really good at borrowing and make sure you're going to pay back without going overboard here. A cash out refinance isn't necessarily for everyone, especially if you're not going to use that extra cash to build wealth and just spend it on miscellaneous items. You got to be prudent there. All right, so you also might consider, as always, getting that excess cash invested. I'll always say this. I will always talk about how you can put your cash to better use than letting it sit in the bank, let's say. But now, this might be as important as ever. The higher the inflation, the more your buying power really decreases. So don't get caught with too much excess cash during these times. While you absolutely want to have at least 3 to 6 months worth of cash set aside for emergencies. You've heard me say this over and over again. Time is your biggest asset when it comes to investing. Rates are expected to go up. You might want to get ahead of that uncertainty and start now and get your money invested rather than wait it out. You probably are seeing all these fears in the news, that the Fed's raised rates and there's going to be a huge stock sell-off, right? Well, I can guarantee you that no one can actually predict the future, no matter what they say. So why buy in on these predictions and sit on the sidelines? Letting that fear hold you back from investing could do a lot more harm than good over the long term, because this is just another form of market timing. As long as your time horizon is at least 3 to 5 years or more in the future for these funds, you don't need these funds for the next few years. The short-term fluctuations that you may experience in the next few years with investing have little to do with the long-term accumulation of wealth. And speaking of investing, with continued increased inflation and potential rate hikes, you also want to consider the importance of diversification. Inflation may not affect all parts of the global economy the same way, and none of us know if the US will fare better or worse during this uncertainty. Yes, the US has significantly outperformed the rest of the global market in the last few years, but who knows if that'll continue? I'd encourage you to consider spreading out inflation risk by investing across the global market using ETFs or some kind of strategy that gives you exposure at a super low cost to the broad global stock market. This type of strategy, whether it's high or low inflation, takes the guesswork out of picking stocks or even certain sectors and allows you to hedge against certain countries' economies underperforming others. And lastly, what about crypto? More people are talking about crypto as an inflation hedge and constantly arguing for the case as to why you should throw all your money into crypto before inflation gets worse. And while this may be true, again, no one actually knows the future here. It's hard to believe that there's actually one asset class like crypto, or Bitcoin specifically, that will truly act as this mythical hedge over time. Sure, it does make sense at a high level. Prices are skyrocketing, and while the feds can always print more dollars, Bitcoin and other crypto and currencies, they're finite, so they can't do that. The issue here is that cryptocurrency and Bitcoin especially is super volatile, and you gotta be willing to withstand some pretty significant swings up and down. We've seen Bitcoin go down in value by 50% in such short time frames, so it's tough to argue for this as an inflation hedge when inflation is a slow, chronic process. Bitcoin can move in a single day as much as inflation moves over multiple years. I certainly get using crypto as part of a diversification strategy, but I won't buy in on any strategy that recommends going all in on a specific type of asset. For this reason, I would encourage you to look at crypto as a part of a bigger strategy, which is simply to spread out your money across many types of investments with the end goal of building long-term wealth. Crypto can certainly be a great complement to this, but just keep in mind that you're adding a lot of volatility to your portfolio in doing so. All right, thanks for joining. This is Tony from Wealthfront. Hit that subscribe button, and we'll see you next time.